For every 1 ounce of silver physically deliverable at COMEX right now, there are 4 ounces of paper claims outstanding, 4 to 1, and Shanghai is paying $4 to $5 more per ounce than the New York paper price. Both of those conditions exist simultaneously. Right now. Today. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Silver closed at $68.63 per ounce on March 26, 2026, down 2.01 on the session, with an intraday range of $66.78 to $69.66. That range is not a market-finding fair value. That range is a paper market disconnecting from physics. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. COMEX registered silver inventory versus open interest. COMEX registered silver, the only stock immediately deliverable against futures contracts, stands at approximately 103 million ounces. Total open interest on COMEX represents approximately 429 million ounces of paper claims against that stack. That is a coverage ratio of 24%. 24%. As of March 26th, 1,981 contracts representing 9.9 million ounces remain open heading into April 2026 first notice day, now 2 business days away. That is the critical deadline. When first notice day arrives, holders of those contracts must either roll or stand for physical delivery. The ones standing for delivery demand real metal, not a cash settlement. The timing of this is what deserves scrutiny, not the data alone, the timing. Think about what that sequence actually means. A paper-to-registered coverage ratio of 24%, heading into a delivery cycle, with April 1st notice, day 2 business days out. The ones paying attention already know what that combination has historically preceded. Before I show you the full data picture, consider this. In early to mid-January 2026, 33.45 million ounces of silver were physically withdrawn from COMEX registered inventory in a single 7-day window. That is 26% of registered stock, gone in 1 week. That pace has moderated since, but the directional trend has not reversed. At the current withdrawal trajectory, COMEX registered silver stocks are estimated to deplete in approximately 170 trading days. Now let's build the full picture, because COMEX inventory data does not exist in a vacuum. The Shanghai Gold Exchange silver spot price, converted to U.S. dollars, is trading at an estimated $71.50 to $72.50 per ounce, a $3 to $5 premium over COMEX spot. That premium represents 4.5% to 7.5% above New York pricing. The SGE requires physical delivery. COMEX does not. When the world's largest silver-consuming nation is paying 4.5% to 7.5% more for silver in a physically settled market, while COMEX paper sells off, the divergence is not noise. That is not coincidence. That is a pattern. The March 2026 COMEX futures contract alone represented over 500 million ounces of silver, more than 4 times the total deliverable supply. This system functions only as long as traders roll contracts forward rather than demanding physical metal. Each delivery cycle that sees elevated standing for delivery stress tests that assumption. The ones who have been dismissed for pointing to the paper-to-physical ratio discrepancy are not saying much right now. The data is doing the talking. And here is what makes that picture even harder to ignore. The gold-to-silver ratio has widened to approximately 64.4 to 1, reversing silver's brief outperformance from the previous session. A ratio above 64 historically indicates silver is undervalued relative to gold. But in the current environment, that undervaluation is not being created by demand destruction. It is being created by paper selling pressure on COMEX while industrial demand from photovoltaics, electric vehicles, and electronics continues to absorb physical supply at the source. China is the world's largest silver consumer. China is paying $3 to $5 above the COMEX price for physical silver right now. At the same time, the DXY near 99.89 and 10-year Treasury yields at 4.46% are applying real suppression pressure to silver's financial asset component. That is not a contradiction. That is the setup. Industrial demand structurally intact. Financial asset component under paper-driven pressure, both simultaneously. Setups of this kind can take a long time to resolve. Anyone who claims to know the exact timing of the resolution is selling something, What the data tells you is the structural picture. The timing is a completely separate question. Now the macro, because the U.S. Iran conflict is no longer background noise, it is the primary pricing variable. Here is the number that most people are not connecting to silver. China's photovoltaic manufacturing sector consumed approximately 193 million ounces of silver in 2025 alone, roughly 20% of total global silver supply. That demand does not slow during an energy-driven geopolitical environment. It accelerates. Energy uncertainty accelerates solar investment. Solar investment accelerates silver demand. Brent crude above $100 per barrel for the fourth consecutive week signals sustained energy supply disruption. Markets are still pricing a contained conflict with a de-escalation pathway. Look at Brent holding above $100 and tell me what probability you put on a clean resolution before the April delivery cycle closes. When the market fully prices the inflation reality of an extended U.S. Iran disruption, industrial commodities reprice higher, silver reprices higher. That is the historical pattern. Every time sustained energy disruption has collided with elevated industrial silver demand, the paper price has eventually converged with the physical signal. It has not been different yet. Any weekend escalation, a straight incident, a geopolitical headline between Saturday and Sunday, gaps silver at the Asian Monday open with zero Western liquidity available to absorb it. Silver is more volatile than gold on gap opens. That risk is live right now heading into the weekend. Silver COMEX Western spot at 68 on 63. Shanghai Gold Exchange physical spot at approximately 71.50 to 70 Tau 50 per ounce, a $3 to $5 premium that the physical market is paying over the paper price right now. The short-term picture is binary heading into Monday. If April 1st notice day sees elevated standing for delivery and the registered stock conversion capacity is tested, the premium widens and paper pricing comes under upward pressure. If the Iran situation moves toward de-escalation over the weekend and leveraged longs roll their COMEX positions without incident, silver retests the $66.78 intraday low and potentially extends toward the $62 to $65 support zone from late February 2026. That is the if-then. That is the only short-term read that matters right now. As for trading it, I cannot see a clean directional setup on the lower time frames going into a weekend gap with this much open interest outstanding. I cannot tell you what silver does Monday at the Asian Open. Nobody can. Sidelines is not weakness in this environment. Sidelines is the only edge available before liquidity returns. I have called this market in both directions. I will call it again when the picture clears. Right now, the picture is not clear. The tape decides. Not me. Here is the honest truth. Both sides of this trade have a real argument, and the one you ignore is the one that costs you. So let's run both. The bear case is real. The bear. First, the 10-year Treasury yield at 4.46% and markets pricing a 50% probability of a December 2026 Fed rate hike create direct headwind pressure on all non-yielding assets, including silver. Second, if the U.S. Iran conflict de-escalates and Brent crude falls below $85, the energy-driven inflation premium embedded in silver's industrial demand narrative weakens, and speculative longs capitulate toward the $62 to $65 support zone. Third, a DXY recovery above 101 would mechanically pressure silver pricing by raising the dollar cost of holding and importing bullion internationally. The bull case is equally real. First, COMEX registered silver at 103 million ounces against 429 million ounces of paper claims creates a 24% coverage ratio that structurally cannot absorb a sustained delivery demand event without forcing a price reset. Second, the Shanghai Gold Exchange physical premium of $3 to $5 per ounce confirms that the world's largest silver consumer is treating $68.63 as undervalued relative to physical supply tightness, not overvalued. Third, China's photovoltaic sector alone consumed approximately 193 million ounces of silver in 2025, and that structural industrial demand does not reverse on a paper market futures-driven price signal. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown in this analysis points to one structural reality. A 24% paper-to-physical coverage ratio heading into April 1st notice day, with Shanghai paying $3 to $5 above COMEX spot, is not a normal market condition. It is a system running on the assumption that holders roll. The day that assumption breaks is when the numbers stop being theoretical. Don't take my word for it. Verify every number I gave you today. Check the data yourself. COMEX Silver Warehouse Reports at cmegroup.com. Shanghai Gold Exchange Daily Benchmark Pricing at sge.com.cn. Silver Industrial Demand Data via the Silver Institute at silverinstitute.org. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.